Good afternoon, everyone, and welcome to the breakout room. My name is Atul Mehra, and I will be talking today about the tax implications of options investing in Canada. Today's agenda will include an update on the 2020 personal and corporate tax rates in Canada. I'll be talking about the basic concepts of a capital gain, as well as the difference between income and capital from a tax perspective in Canada, and look at some different corporate and personal tax structures that are available to options trading investors, as well as some Canada Revenue Agency interpretations on this topic. We'll be looking at an option to file a T123 election to lock in some tax treatment for capital gains in certain circumstances. Look at some rollover provisions on how to transfer assets from your personal name into a corporation. Look at some tax court cases on this topic that have gone through the courts over the last few years. Look at some tax-free savings account and RSP contribution planning implications for options trading, and some other tax planning options and alternatives that are available. Quick background about myself. My name is, again, Atul Mehra. I'm a graduate of York University with a Bachelor of Commerce degree. I have a Chartered Accounting designation in Canada, as well as a Certified Public Accounting CPA designation in the United States of America. I'm licensed to practice public accounting in Canada, as well as the United States. And I'm the leader and founder of M&Co Chartered Accountants LLP, and the leader of our international and domestic tax group. I assist clients with designing and implementing simple as well as complex tax structures, estate planning, corporate finance, help with mergers and acquisitions, and business planning. I'm also on the board of directors of a private equity firm, Morix Capital Corp. We're a mortgage investment corporation operating in Toronto. And I've completed the CPA Canada 3-year in-depth tax course. I'm a member of the CPA Institute in America, as well as a member of the Canadian Tax Foundation, a member of Rotary International, and the treasurer of the Rotary Passport Club. Now, today's session, the big idea for today that I want everyone to keep in mind in terms of tax planning is that no one situation is the same. You have to maintain flexibility, and you have to look at all the facts and circumstances surrounding your particular situation to get to the most optimal tax strategy. Tax planning, it encompasses creativity, design, planning, risk management, all into one. And you have to take that into consideration when you're looking at your tax planning decisions. Proper planning is key and necessary in order to achieve your desired goals and objectives. Whether those objectives are to increase your return on your investment, minimize your taxation, or protect your investments from risk, the structure you implement can result in a win-win situation. So I want to take that into consideration today. The big idea, tax planning is all encompassing. It's important to take all these factors into consideration. Now, the first area that I want to talk about was the 2020 personal combined federal and provincial tax rates. Now in Canada, we have a progressive tax system. It's based on a marginal system. So here you have a schedule of the different tax rates that apply to different types of income, depending on your taxable income bracket. So in Canada, the high tax bracket on income that's earned, such as employment income or self-employment income on your personal tax return, is taxed at the high rate on any income over $220,000 at 53.53%. Now, capital gains are only taxed at 26.77%. And that's because capital gains are only taxed at 50% of that of regular income based on current enacted tax rules and regulations. So, for example, if you're making $220,000, you're going to be paying $80,691 in tax. Now, depending on what type of income you have, the marginal tax bracket will change depending on the nature of that income. Now, for corporations in Canada, the combined federal and provincial tax rates are lower in general than personal tax rates. For example, if you're qualified as a small business corporation in Canada, and for example, operating in Ontario, the combined federal and provincial tax rate is only 12.2%. And over here, we've listed some of the other combined federal and provincial corporate tax rates for small business corporations in Quebec, British Columbia, Alberta, and Manitoba. And as you can see, they're a lot lower than the personal tax rates. And that tax rate is only available on the first $500,000 of net income in a corporation. When I say net income, I mean the difference between your business income and your expenses would be your net business income. In terms of the basic calculation of a capital gain and the formula and the concept of a capital gain, that concept is actually defined in the Canadian Income Tax Act. The regulatory framework for that is subsection 41 of the Income Tax Act. And it provides that gains and losses from the disposition of property is equal to the proceeds of disposition, less the adjusted cost base and expenses of sale. That's the basic concept of the calculation of a capital gain. Now, in this particular course, you've been learning about a specific option trading strategy. And in those strategies that you're learning about, you're going to be a net seller or writer of a put option, or the net seller or writer of a call option. Most of the strategies that you've learned about over the last few days have been regarding naked put options and your obligation to buy a security in the future for a fixed price. And from a tax planning perspective and a tax issue perspective, I'm going to be talking about that particular strategy today. Now, the first issue that comes to mind when you're dealing with this type of strategy is the type of income that it is, whether it's what we call as income on account of income or on account of capital. So the first fundamental concept is to understand that concept so that you can learn about how to apply it to your trading activity. So as a little bit of a history, back in 1981, the Canada Revenue Agency had posted an interpretation bulletin entitled IT 479R, Transactions and Securities. So almost over 40 years ago, the Canada Revenue Agency had already provided guidance, which is still holding water today, about this topic. And they had established guidance on the gains and losses on the dispositions of options trading. And in that circular, they had actually gone into detail about how securities transactions are going to be treated, and specifically whether they're going to be treated as income and taxed as income or taxed as capital. So some of the factors that they had proposed in that bulletin are as follows. The first factor was how frequency, or the number and the frequency of the transactions. So generally speaking, if you had a high frequency of transactions or a lot of trading, it was probably considered income. If you had a low frequency of transactions, it would be taxed as a capital gain. So when you're selling naked put options, for example, and they expire in, let's say, 30 to 45 days, that could be considered a high frequency and therefore potentially taxed as income, depending on the nature of the expiration of the contract. Now, the period of ownership was the second criteria. So how long were you holding the securities? So if you're holding them for a long period of time, they could be considered capital. If they're held for a short period of time, they're considered income. Now, with options trading, generally speaking, in the strategies that you're learning, depending on your expiration date, there's usually a short expiration date, and a quick turnaround of those securities. The other factor that they introduced was the knowledge of securities. They felt that was an important factor in determining whether somebody was carrying on a trading business. Essentially, if you were having a high knowledge of securities, then it would be more likely that you'd be doing a business and you'd be earning income. If you had a low knowledge of securities, that would be more likely to be considered a capital gain and you're more of an investor rather than running a business. So some of the things that can come into play in those circumstances is courses that you're taking or training that you're doing that could help contribute to your filing position as to whether you have a high or low level of securities, as well as your background in the trading that you're doing. The fourth factor was whether the security transaction was part of an taxpayer's ordinary business activity. If it was part of their regular business activity, then it would be considered income. If it was more of a non-business type of structure, it would be considered capital. So it's important that these things get documented in your bylaws if you own a corporation, or if you're personally in some sort of trading account or some sort of business license. Now, the other factor was time spent on that activity. So if you spent more time trading on an active basis, it's more likely to be income. If you spent less time doing it and were doing it more casually and intermittently, then it would be considered capital gain. So that was also depending on the facts and circumstances behind that individual's particular case pattern. The other factor they came into was financing. Were you using margin to invest? And were you taking on any risk? Essentially, if you were taking on more risk or more margin or leverage, then it would be considered income. If it was less leverage, then it would be considered capital. So if you're using a home equity line of credit or margin, it could be potentially considered a factor for it to be income or a business. Another factor was advertising. That doesn't really come into play too much in the trading business, but it could. And if you're doing more advertising, it would be considered income or a business. If you're doing less advertising, it would be considered capital. And the last factor was the nature, type, and quantity of the shares. Intention to collect put option premium. If that was your primary intention rather than the actual ownership of the security, that could weigh into the decision as to whether it was income or capital. So it's important to understand that it's not just one particular factor, or if you meet factor number 1 and don't meet factor number 8, for example, that you would necessarily be income or capital. But it's important to understand that it's looking at all the factors holistically to determine whether something is considered income or capital for a tax perspective. Now, in terms of the concept of how income and capital is taxed, it's very important to know that when you're looking at your tax plan. So if it's income, it's 100% taxable and it's included in your income at the marginal tax bracket. And if you lose money and it's treated as income, then it's 100% deductible against your income. If you lose money, you can carry those losses back 3 years, either to the first preceding year, the second preceding year, or the third preceding year. Or you can carry that loss forward for 20 years and you can apply it against any income. The other important consideration is income. If taxed as income, it can be considered earned income for RRSP purposes. And you can also deduct your business expenses against that income. Now, if it's taxed as capital gains, it's only 50% of it is taxable. So if you have a capital gain or a capital loss, only 50% of it is taxable. Now, the same concept applies to the losses. If you have capital losses, you can only deduct them, however, against capital gain. You can't apply those capital losses against other income, like employment income or self-employment income. Similarly to the other losses, if you're running a business or running it at income, these losses can be carried back, again, only applied against capital gains. And they can also be carried forward and they don't expire, and they're available indefinitely until a terminal return. Now, if you have any deductions, those deductions are limited to commissions that you're paying on your trades, as well as interest or leverage on any leverage that you're doing for security trading purposes. Now, looking at the CRA's interpretation of that bulletin that I mentioned earlier, they actually specifically noted naked options in their document, the interpretation bulletin. So they had said that in their opinion, someone who does not, who has a stock option, they would consider the gain or loss on the stock option to be considered normally as income, so 100% taxable. However, in the same interpretation bulletin, they also stated that they would accept the transaction to be taxed as capital gains as well, which is only 50% taxable. They only cited that the tax rate would have to be consistent in their treatment, consistently from year to year, treating it as income or capital. So generally, the CRA was relatively flexible in their interpretation as to how naked put options would be taxed. And the reference for that is Interpretation Bulletin IT 479R. Now, if those of you that are trading and you might be concerned that you may be considered quote unquote day trading or high frequency, and you don't want the transaction to be taxed as income because you're in the high tax bracket, there is an election that you can file. And election is essentially a form that you file with the federal government along with your tax return, and it protects your filing position for it to be taxed as a capital gain. Now, the great thing about this election is it protects your filing position. So if the CRA was to come back and say, look, you look like you're day trading, this is income, and say, well, no, I filed the election and I want this to be treated as a capital gain. And that's the way that it'll be solidifying your position. Now, the disadvantage is that you can't renege the election once you file it. So you can't change your position. For example, if you lost money on trading, you can't say, well, I want to treat that as a loss against my regular income. You have to treat it as a capital loss, which can only be applied against capital gains or carried forward against other future capital gains. So that is one sort of disadvantage. The other thing to consider is that it's only available on Canadian securities. So a lot of options trading is done on US positions. So this particular election wouldn't help you in those cases, but it does provide some advantage and filing position protection. So generally, I would consider maybe not filing it in certain circumstances to protect your filing position in case you change your position. However, the other thing is to maybe look at trading in multiple jurisdictions, like having a corporate account or a personal account, maybe with different bylaws and merits. This is the actual election form. It's a one-pager, and you would complete it and send it in with your return. It actually references the IT bulletin that I mentioned earlier, which is 479, and it would be filed along with your tax return. Now, in terms of the tax courts, they have also weighed in on a lot of cases in terms of a lot of people talk to me about, well, how do I know if I'm doing high frequency trading? How do I know if I qualify? So in these 4 cases, people were tested, as well as corporations, on whether they were income or capital from a frequency perspective. In all 4 cases, they were all treated as income. And just to give you an idea, the first case, 460 transactions per year. Second case, 267 transactions per year. Third one, 120 transactions a year. And the fourth one, 75 transactions a year. And all those cases, each of them was found to be on account of income. So it's treated as income, which would be subject to the lower tax bracket of 12.2%. However, you have to look at your particular circumstance. So that gives you some guidelines as to the frequency. In the United States, they've created a benchmark for about 4 trades a day to be eligible for a business status or tax trader status in the United States. So it gives you a little bit of benchmark. There's another case where it was treated as capital. The person only had 23 trades in the year. So it gives you a little bit of background on some tax code cases in terms of frequency of trading. As you know, or may not know, when you do a brokerage transaction, the brokerage will send a slip for each trade to the Canada Revenue Agency on a slip called a T5008. So generally speaking, the Canada Revenue Agency will have an idea on the frequency of trading of an individual based on the number of T5008s that are reported to the CRA by the broker on an annual basis. Now, in terms of the courts, they had also initiated the same bright line test that I talked about earlier that was in the interpretation bulletin in determining whether something was income or capital, the number of transactions, the intention of the purchaser, how long you've held the securities, the quality of the securities, how long the time devoted to stock transactions by the investor or the business owner, the extent of the borrowing, and the expertise and knowledge of the individual. So all of these weighed in the bright line test of the tax courts. And important note, no single factor is determinative, just like the interpretation bulletin, but it's important to know that the tax court echoes some of the CRA's position on the income versus capital issue. Now I'm going to go through a quick example of a practical example of an option contract and how it will be taxed. So here's an example of selling one naked put option contract with a strike price of $130, expiring in 63 days. So this was back in August 15th of 2019, and it was a Microsoft position, and it was an option contract that expired with a premium of it was $4.05, and for 100 shares. So in this particular case, I mean, it's a while ago. Microsoft was trading at $135 at the time. I think now it's probably trading at $235. But at that time, the option, let's say the option premium expires, the individual would have a triggering event, which they would earn $405 on that one contract. So to take that through, let's say that the instead of the option expiring, the same example, Microsoft trading at 135. You're selling one naked put option contract expiring in October in 63 days, strike price of $130, and it's paying a premium of $4.05. And then you go ahead and you still get paid your premium, but then let's say you have to exercise the option gets exercised, and you have to take position of the stock. So you've now purchased the stock on October 18th for $130. So your actual net cost of the security would be $130 that you paid minus the $4.05 premium. So your net cost of that actual security is $125.95. So let's say a few months later, you decided to sell the security when the shares were trading at $158 a share. So that would be sort of the life cycle of fact pattern that would be common in this particular strategy. Now, in terms of the tax consequences of this, now the tax consequences of this can be very different depending on how you're structured. So if it's structured as a capital gain and you're a personal individual, you're going to have the proceeds of disposition, the $158 which you sold the securities for, the $125.95, which is the net cost of the investment, which is the exercise price less the $4.05 for the option premium. So you have a capital gain of $32.05. Then you have to pay tax at $8.57, assuming you're in the high tax bracket at 26.77%, and you'd be left with $23.48 per share. And on that option contract, there'd be 100 shares, so you'd be left with a gain of $2,348 net cash flow. And if you take the same facts and circumstances and apply them to an individual, and that same transaction was treated as income rather than a capital gain, you'd have the $158, which would be the proceeds of disposition, the cost of the investment, which is $125.95. But instead of it being taxed at the capital gains rates of 26.77%, you'd be taxed at the high tax bracket of 53.53%. So then you're only left with $14.90 per share, or $1,490 in your pocket. So that's almost 37% less cash flow in your pocket, just because you're taxed rather as income rather than as a capital gain. Now, if you incorporate a company, then it's treated as income, then you're going to be left with $2,814 in your pocket, because the corporate tax rate is only 12.2%. So that's about a 20% more after-tax cash flow versus it being on the personal side as a capital gain, versus an almost 89% more after-tax cash flow, whether it's treated as personal income, which is the high tax bracket. So the way you're structured can make a significant impact on how you're taxed and how much money you keep in your pocket. Now, in terms of different ways of being structured, whether as an individual, you can be an individual investor. Just a quick summary: you're in the high tax bracket, limited tax planning options. It's a simple structure. You're gonna have the 53.53% on the high tax bracket if it's treated as income, and 26.77% if it's treated as capital gains. If you're treating this as an individual, you're gonna have to file a Schedule 3 on your personal tax return. You're going to report the capital gain if it's treated as a capital gain. If you're treating it as income, you would file it on the T2125 as business income, and then you would report the proceeds as income on this schedule as well here, and then you report the expenses and the cost of sales as well in the expense section. And That would be your personal tax implications if you are treating it as an individual. Now, the other option is you can incorporate a company, and the investor would incorporate a company, and they would get the 12.2% tax rate if it's treated as business income. And you would have to, now, if you have, and a lot of people do have investments in their personal hands, and they want to transfer it to a corporation, there is a form you can file as a T2057 filing, and allows you to transfer those investments to a corporation on a tax-free basis. This is a copy of the form to do that. You'd also have to file a corporate tax return. So there's a little bit more complexity in filing requirements if you have a corporation. And here's some other structures that we do see a lot of, where there's a corporation, the investor may bring their spouse, their parents, or their children, or other family members as shareholders for tax planning purposes. If you have a second corporation with a real estate company, you may structure in such a way where the share structures are split between family members. This is another option to consider in terms of tax planning. For those of you that are running other active businesses, you may separate your investment trader company from your active business and your real estate company with other family members in order to take advantage of other tax structures and advantages depending on what other business interests you have. So there are different structures available. It's important to know about those, and it can really depend on your facts and circumstances and which structure works best for you. Another important consideration to look at is the dividends. If you're receiving dividends from US securities, the American company, before they pay the dividend to you, they will actually withhold taxes on it of about 15%, and they'll send it to the IRS. The good news is when you file your Canadian tax return, there's no double taxation on that. So you will be eligible for a foreign tax credit on any foreign taxes paid to another jurisdiction like the IRS. So you file your Canadian tax return, you will be able to claim a credit for that. Other big picture stuff to think about, if you're looking at doing some stock option trading in your TFSA or RSP, there are restrictions where you can only do it on covered calls when you actually own the security. You can't do that strategy within RSP for naked put options. Keep in mind the principle of integration. There's no double taxation between having a corporation and individual. There's some tax concepts known as a capital dividend account, dividend refunds, and refundable dividend tax on hand that ensure that there's full integration between holding money within a corporation and personally, so there's no double taxation. Look at estate planning. Make sure you have dual wills in place. If you do have a corporation, we have a will personally as well as a corporate will. And also monitor the tax changes that come out during the federal budgets, because they can be very important, any changes to the tax rules to your particular tax strategy. Here's a quick summary and update on the RSP contribution rooms for 2020, $27,230 is the maximum amount. TFSA limits are up to $75,500, so keep those in mind when you're doing your general tax planning. And I took this from the Interactive Brokers on their website. It just gives you some guidance on some situations where stock trading is available, option trading is available in certain circumstances in your registered accounts and TFSAs, but naked put option wouldn't, but some of the other long put and call options strategies do work within the TFSA and the RSP. So back to the big idea, tax planning advisory is very similar to investment risk. It involves creativity, design, tax strategy, tax risk management, all into one. No one situation is the same. Tax planning decisions made and positions taken by each individual business and family group is unique to each one's interest. Proper planning is key and necessary to achieve the desired objectives. Whether those objectives are to increase your return on your investment, protect your investment, and protect your investment from risks, structure the tax structure that you do and the strategy that you have can result in a win-win situation. So keep that in mind when you're doing your tax planning. And here's my my information, my contact information. If any of you want to reach out, we are on the Facebook page for the Theta Trading Group. If you want to do a private consultation, we can do a Zoom call, send me an email, we can structure something. We've been servicing the investment trading industry for over 15 years, and we look forward to seeing you on the Facebook page. And we'll see you guys back in the regular room, and we can take your questions. If anyone has any questions, please, we'll review all your questions in the chat, and we'll review them in a few minutes. And other than that, happy trading, and look forward to meeting you all at our next corporate event. Thank you so much.